Hey, this is Geoff Gannon, and you're listening to the Focus Compounding Podcast. This is the podcast where Andrew and I talk general investing concepts. To learn about specific stocks I like, go to focuscompoundinggazette.com. That's focuscompoundinggazette.com, and enter your email. Once you enter your email, you'll start getting one free 2,000-word stock write-up a week. Andrew and I also manage accounts for clients. To learn more about our managed accounts, email Andrew at info@focuscompounding.com or text or call Andrew at 469-207-5844. And now here's Andrew with your regularly scheduled podcast.
Welcome. How is everybody doing? Hope you are doing well. My name is Andrew Kuhn, the Focus Compounding Podcast. I want to thank everyone so much for tuning in. I am sitting by myself today. Actually, it was such a force of habit to say alongside my partner, Geoff Gannon, but I am by myself. But we do have a very special guest, Mr. Vitaliy Katsenelson. He is one of the pioneers in the blogosphere space. And, when he reached out, or his assistant reached out to bring him on the podcast, we were super excited, Geoff and myself, because him and Geoff started blogging right around the same time on all things investing related. So we were certainly excited to bring him on the podcast here today. If you don't know him, you definitely should. He's a CEO of Investment Management Associates. He has his CFA. He writes at the popular website Contrarian Edge, which is how I'm sure a lot of people know him. And he's also written 2 books, Active Value Investing and The Little Book of Sideways Markets. Vitaliy, how are you doing today?
I'm doing great. Thank you, Andrew. It's my pleasure.
Yeah, thank you so much for coming on. So where are you from?
So as you can tell from my accent, I was born in Alabama.
Oh, yeah?
I know it. No, I was born in Russia, and I moved to the United States when I was 18 years old in 1991.
Wow. Yeah, that's fascinating.
And so I think my whole family lived in Denver for almost 28 years. Yeah.
Oh, wow. So you're still in Denver right now?
Yes.
Wow,
yeah.
that is awesome. So one of the things I do and sort of the way I like to start all these interviews when I bring guests on the podcast is I have this, and I've always had this for whatever reason, this fascination with stories and how you could be doing one thing and feel like you know, have it all figured out, and then you meet somebody or something changes in your life and all of a sudden you're on this completely different path. So today we're going to be talking about your story, and maybe you could just sort of start and go back to how you got into investing and sort of lead it all the way up to what you're doing today, and really tell us about your story.
So I'm going to start from the end a little bit. So I have my oldest child, my son, Jonah, is 18 years old. And I was kind of thinking about this a few months ago. When I was 18 years old, I had absolutely no idea what I wanted to do. And the only reason I was thinking about it because my son, Jonah, today has no idea what he wants to do when he grows up. And I remember how terrified I was that I had absolutely, I knew I did not want to be, at the time I was still in Russia. I was still attending Murmansk Marine College, which was basically a way for me, I basically went to the school so I would not have to go to the Russian army. At the time, Russia had a draft army, and I heard it's changed, but then going to the Russian army was almost like serving a 2 or 3 year prison sentence because there was a lot of abuse. It was usually you go to the army, they would send you 2,000 or 3,000 miles away. It just was a kind of very, it's really, at the time, it was not much different than going to prison, really. Just that's how parents treated that. It wasn't because of wars. It's just because at the time when 1991, Russia was not fighting anybody anymore. But anyway, so at the time I was going to Marine College, and I knew that I absolutely hated what I was studying, and I did not know what I wanted to do. And then luckily my family moved to the United States, and I discovered that I'm actually wired fairly well to do computer stuff. So as a hobby, I became fairly good with computers. And so when I went to CU Denver, I knew I wanted to do something in business, but I didn't know exactly what I wanted. Maybe I thought maybe I would be a lawyer, maybe do something with computers. And then I got a job with an investment firm, and they hired me because I had computer skills. And maybe 6 months into this job, I realized, my God, I love this. I love finance. I love building financial models. I love thinking about businesses. So I was maybe 21 years old then. So I changed my major for the last time to finance, and that was it. That's I knew I wanted to invest in, and that's basically how I got into it.
Wow, yeah, that's certainly interesting. And I'm always curious just to hear about how the bug bit them, right? It's kind of like my partner Geoff, his dad gave him a book, which is actually security analysis. And he said, you're always talking about investing. And I heard about this book by Benjamin Graham, and it sounds like this is exactly what you're talking about. So why don't you check out this book? And Geoff, that's how he got into investing. And Warren Buffett's case, for example, his dad was a broker, and that's probably how he, sort of the bug bit him. And my case was a little bit similar to that. So I'm always curious to hear about how people got into investing. So that's certainly interesting. So was the firm that you were at, was it more of a value-oriented approach? I'm always kind of curious to hear how people's sort of investing evolution goes on. How was that for you?
Yeah, so it's very interesting. So the firm I joined at the time was a PVG Asset Management, and I was, so that was a firm where I kind of was introduced to investing, but they didn't need me. They did not need somebody helping with investing. So I left and I joined this firm, and this was like 1997. So this is 22 years ago. And when I joined this firm, our approach was a little bit kind of growth at reasonable price. We would buy high quality companies, we would pay fair prices for them, but they would grow their earnings, and that would be the source of our return for the most part. Not the price, just the growth of earnings. Over time, so this is how I started really kind of investing. In 2001, market collapsed. Our stocks did great. Because we owned high quality companies that weren't, that were more or less fairly valued, but they weren't. But they were. We did not benefit from the dot-com boom, but but at the same time we benefited from the dot-com bust.
Sure. Yeah.
And then the few years that followed, I saw that our stocks did fairly poorly, and this is how I kind of stumbled on my sideways market thesis, because I started to look back, and because I thought, well, we own high quality companies, why aren't they doing so well? And then I realized that there's such thing as market cycles, and that when I started in this business, I focused a lot more on the growth. I did not spend as much time thinking about margin of safety. Okay, and so two things happened. Number one, when I realized that when the market go from boom to bust, then you're gonna have a price to earnings compression. And that automatically kind of made me a value investor, because I realized, well, when I buy stocks, I want to make sure that they have margin of safety. But it also made me look at the market cycles, and this is how basically, this is how active value investing came about. One thing, Andrew, I found is that some of the most important moments in our lives happen because of some kind of pain. Like, not making money in 2002, 2003, or maybe even lost money, was a very painful experience. But there were so many, I'm so glad I went through those experiences, because it shaped me. First of all, it turned me into a value investor, and second of all, it helped me, it's helped me to write, it was an instigator for me to write 2 books that followed.
Sure. Yeah, and it's interesting how, I guess, the experiences that people have, even in the investing world, but not only that, but also in life, it really shapes the way that they invest, the way that they look about things, and all things related to that. So that's pretty interesting.
Yes, I think the pain is something that when you as any investor will go through a period of time where investing causes pain. If you don't go through that period of time, that means you're not doing, either you're lying to yourself or you're not doing something right, because your style will always going to be, at some point, is going to be out of sync with the market. And to me, I look at the periods in my life when it's when investing caused me pain as probably the biggest growth spurs in me as an individual, as an investor, for sure.
Sure. No, I think that's I would definitely agree with that. I mean, not only in investing, but in life as well. And I think Joel Greenblatt talks about all the time, value investing works because it doesn't always work. And if it did always work, then people, then it wouldn't always work. because it would just get sort of arbitraged away. So I definitely agree with you on that. So tell me a little bit about you spoke about this a little bit earlier, the sideways markets thesis, and what's that all about?
Sure. So if you look back over the last 100 years, and now I'm going to use a few terms, so I need to define them ahead of time. So you have two types of markets. You have a cyclical markets and a secular markets. Cyclical markets, basically, it's all about time frame. It's a time period of maybe 5 years or less. And again, those are very vague definitions. And then you have secular markets, secular cycles that last 5 years or longer, maybe 5 to 15 years or so, 5 to 20 years. So when you look historically at U.S. markets, you find that every time we had a secular bull market, that lasted maybe 15, 20 years, the market that followed was not a bear market, but was kind of a sideways market. So market going up and down with a huge amount of volatility. So kind of a large number of cyclical bull and bear markets inside of them. But at the end, they kind of, for 15 years or so, they basically go nowhere. And I wanted to understand why that happens. So I saw the chart, and the chart intrigued me. And one thing I realized, think about if you look at the stock prices and you completely ignore dividends for a second, the stock prices go up in the long run for two reasons. It's kind of a very simple mathematical equation. It's really earnings growth and price to earnings expansion or contraction. When people say that on average stock prices, your stock market trade about 15 times earnings?
Sure.
Okay. So if you keep that number constant at 15 times earnings, you would basically not have bull and kind of sideways markets or bull markets. Your stock markets would basically grow about 5 or 6% a year. And that would be the growth of earnings or growth of GDP. Okay, so you would basically, it would be not quite a straight line chart, but almost a straight line chart up, but it would be a very gradual, 5 or 6% a year. Okay, you're going to have periods where the earnings grow a little bit faster or lower because profit margins go up or down, but on average, it would be very similar to growth of the economy. Now, when you introduce price to earnings, that's where it gets interesting, because what happens, price to earnings goes through the cycle of like a pendulum swing. It goes from below average through average to above average. And that swing from below to above basically adds a return on top of the earnings growth. So if earnings grow in 6% a year, okay, and price to earnings goes from 6 times earnings to, 25 or 20, 25, whatever, then that adds to the return of the stock market. So suddenly returns are not 6% a year, but maybe 10, just from stocks. Remember, I'm ignoring dividends. 10 or 15 or 20%. The only problem is that as the price to earnings, that pendulum swings to the extreme, at some point it's going to mean revert, and it always does. And that mean reversion takes away that extra return you got, like this additional 4 or 5% return you got, and that's how you get. So if economy is growing 5% a year, and price to earnings declining now from 25 to 10, then your 5% return from earnings growth is taken away by PE compression, and that's how sideways markets happen. So if you think about it, in the long run, returns for stocks were about, let's say, 10, 11%. So 6% of it came from earnings, basically price going up, and another 4 or 5% of it came from dividends. So what happens basically in sideways markets, if you look at the last sideways market we had at the time of my writing, was 66, 82. Markets in 1982, they were at the same level where they started 60 years before. And the only return you received during that time was dividends. That's it. So that was my thesis when I sat down to write Active Value Investing in 2005. And Active Value Investing came out in 2007. And then in 2010, I took Active Value Investing, which was basically a book written for people like you and me. Like it's a 270 pages 75 charts and tables, very technical book. And then in 2010, I took that book and basically simplified it for kind of your neighborhood dentist. Somebody who's a smart person, but who doesn't necessarily know all the lingo and doesn't want to go through 75 charts and tables. So the Sideways Markets book had only 5 tables and charts altogether, and it's 1/3 the size of the original book. The problem, though, what we discovered since that what I did not see when I was working on my first book, I did not realize that we can have interest rates go from normal level to 0 to negative. And I think that changed kind of the DNA of the stock market a little bit, because we basically in '99 the valuation was the highest ever, and you would expect when you have a very high valuations they go from one extreme to another. But what happened was the price to earnings went from, let's say 30 times earnings, and it got to 15, and it stayed there for about a month or two during the crisis, and then went up higher. So it never really the mean reversion never happened. And the reason it hasn't really happened because the interest rates declined so much. And so I feel like my books are more relevant today than they were when I wrote them originally, because now valuations are pushing new highs again. And, and just the sprint of mean reversion has just been loaded more and more.
Sure.
Every day.
Sure. So what's your opinion? And that's all very fascinating. What's your opinion on where we are currently in the market?
We are basically if you look at almost any measure, price to book, which is not necessarily my favorite one, but if you look at price to sales, if you look on price to semi-normalized earnings, we are either the highest or second highest level ever. Mm-hmm. So we are kind of competing now with 1999 levels. So.
Yeah, and we definitely, I mean, by all measures, I always say, I mean, the market is expensive. So how do you make money in a sideways market, and how would you, I guess, position, or what do you think would be a good position for investors going forward on how to structure their portfolio to sort of maybe either take advantage or mitigate against it, if we swing the other way?
So I would suggest investment becomes an active value investor, in the sense that when you look at stocks, first of all, you ask for significant margin of safety. Okay, that's point number one. Point number two, when you value stocks, it's very important to normalize, to realize that at some point in time, the interest rates are not going to be. I mean, it's possible. I don't, nobody knows, but it's very likely that interest rates at some point can be much higher. So therefore, in your analysis, you want to make sure that you're not stuck with interest, 2% treasury bonds, but using semi-normal interest rates in your analysis. That's point number two. Point number three, you want to make sure that you don't fall into relative valuation trap. That the company you're buying is cheap on its own, in the sense that you basically do analysis kind of more or less on present value of future cash flows versus, this company trades at 23 times earnings. Well, it's kind of expensive, but its competitors trade at 28.
Sure.
Well, just because competitors are competitors more maybe overvalued as well. Also, you should not be, if you're looking for companies to buy and you don't see enough companies that meet your criteria, just have cash. So you have to be somewhat opportunistic, and those are kind of the top few things that come to mind.
Yeah, no, and I think that's great, and definitely that'll be great for all of our listeners. So I want to go back to your early 20s, and earlier you had said that you joined a firm. Was that when you joined Investment Management Associates? Or is that a different firm? Okay, wow. So you've been with them then since your early 20s. And
oh no, I'm sorry. Let me clarify. So I joined IMA in 1997. My first job was I joined another investment firm. So
got it.
So you want to go back to, I guess, to 94, 95, I guess.
Yeah. So we could actually fast forward to 97 then. So you go from being an analyst to the CIO to now the CEO. I'm kind of curious to hear about how that all transitioned. And obviously, you made your career out of IMA. And I mean, when you first joined on, what was your experience like as an analyst? Were you just, modeling out a lot of stuff on Excel and doing a bunch of financial models? And then how did you eventually make that transition to CIO to eventually become the CEO of the company?
So it's kind of interesting. And I think this would be a good lesson for your listeners. So when I joined AMA, my mentor and now my partner, Mike Kahn, was basically a person I tried to replicate. And Mike is 30 years older than me, so he grew up in a very different era of where you did analysis by reading annual reports and reading value line. So that was his way to analyze companies. And at first, I tried to copy Mike. And it took me a while to realize that I have to find myself. So just because Mike did things in a certain way doesn't mean that I should be doing things the same way. Just as just like Warren Buffett. Warren Buffett does not use spreadsheets. Doesn't mean that you and I should not be using spreadsheets, because maybe Warren Buffett's brain is so much more powerful than ours, so he can do spreadsheets in his head. I can't. So it took me a while to realize that I have to find myself. I have to find kind of what works for me. What's the best way for me to analyze companies. So I found that, for instance, that I really like building financial models not because it helps me to forecast. No, because when I build a financial model for a company, I tend to understand the business better. It makes me start thinking about, okay, what really matters for this company? Okay, is it profit margins, sales growth? How much capital does it take to grow the business? So I start thinking, so by building the model, it's almost like if I was a craftsman, and I was crafting something, I start, thinking with my hands. It's kind of the same experience for me when I build financial models. I start thinking through spreadsheets, and for me personally, it helps me to think that way. So if somebody listens to this and says that doesn't work for me, that's absolutely fine. But you just need to find what works for you. So at first I had to it took me a few years to realize it, but I had to find what works for me as an analyst. Over time, I also had to discover what works for me as a portfolio manager. And so how much time do you spend on macro forecasting? Do you spend no time, or do you spend a lot of time? And I found, and I think I'm going to quote Seth Klarman, who said, we worry macro and invest micro. So that's how I look at macro forecasting. I'm trying not to be a weatherman and worry about next hike of interest rates or what the GDP number is going to be next quarter. I spend no time on this because I have absolutely zero competitive advantage there. But I spend a lot of time thinking about potential risks, kind of the potential kind of climate changing events that could change the landscape of investing, significantly. I'll give you an example. I'm trying to build a portfolio today for an environment where interest rates will be either very high or very low. I want to make sure that companies in my portfolio can withstand both. I want to make sure that there is a tremendous bubble in China, so I want to make sure our portfolio has little exposure to that. So this is kind of when this is how I think about macro. And then as a transition to CEO, that's basically takes you away from portfolio management and analyst, and now you start thinking as a businessman. Because as CEO, in addition to analyzing stocks and running portfolios, now you run a business. And that's a very different skill set from not something you learn in school. And Warren Buffett said at some point that running business made him a better investor, and investing helped made him a better manager, CEO. I would argue the same thing. So it's running the IMA has made me appreciate the value, for instance, value of people. So that it made me a better investor, because today we spend so much more time thinking about management than just thinking about return on capital, for instance.
Yeah, and I would agree with that. I mean, do you think analysts oftentimes forget, because obviously they're reading annual reports, they're reading filings, that like, yes, it really is a real business with real people, and they sort of maybe don't give that enough credit?
Absolutely. I can see that happen. I mean, I can't speak for everybody, but I can see how it's very easy when you get focused on numbers a lot, and when you try to predict what the earnings is going to be next quarter, et cetera, or you forget that that really at the end of the day, it's the people who are gonna can create and destroy value. So, for instance, let me give you a couple examples, like one big example of how things changed for us over the last 3 to 5 years. Today, probably 2/3 of the companies I own, the management owns a good chunk of the company, like sometimes 10 to 20% or 30%. And to me, that's very important, because that means every time they make a decision, it doesn't mean they won't make a mistake, but they won't make a mistake because of indifference or because they're just trying to maximize their tenure with the company, because they're really going to be building moats around the business. And also, when I own a company where management owns a lot of the stock, when things go wrong, I know that these people will be working day and night trying to turn the company around, because again, their incentives are aligned with ours. They want, if this company goes down, for me, it's a 5% position. For them, that's 90% of their net worth. So it matters a lot more for them than actually that's for me. And also for that reason, and this is from a business perspective, all my liquid net worth is invested in the same stocks as my clients own. So I want my clients to know that when I buy a company, that company, for them, that company is going to go in my portfolio as well. In fact, basically, my personal account, I am a client of the firm, basically. So, and therefore, I will never make a decision. I will make mistakes, but it's never going to be because of I'm indifferent.
Sure. And that aligning those incentives obviously is great, even coming from a client perspective, because they know that you're on the same side as them.
Yes.
So I'm kind of curious about your overall investing process, right? I'm a big process person. So, like, for example, when you first find out about a company, like, do you screen for it? Do you kind of just come across it in blogs? How does that happen? And then maybe from there, take us through, when you first get interested in an idea, ultimately to the point of buying it and putting it in the portfolio.
Yeah, so we try to kind of systematize the randomness of of a stock discovery. So because I find that for us, finding ideas is completely random. But I want to make sure that I create enough opportunities for me to have this randomness. In other words, I'm sure just like you, I read a lot of magazines. I spend a lot of time reading different blogs. I read letters by other investors I admire, video screening, video screening. We have a watch list of companies we looked at in the past and said, okay, this may be interesting. Let's revisit it later. So all those things kind of maximize our future opportunity set. So it's help us to possibly finding new ideas. Sometimes I'll be looking at a company for 6 months or a year, or sometimes longer, until one day an insight comes to me and I start looking at the company from a different perspective, because suddenly I have an insight. And that basically means my subconscious was kind of working in the background, kind of analyzing it for me, more or less. But let's say I found a company. And so the first thing I usually do, I go and read the annual report, because I'm really asking myself a question: do I want to be in this business? If I want to be in this business, then if I read the annual report and I find this is a business I can understand, this is the business I want to be in, that means it's a high quality company, then I start thinking about, okay, well, what is the company's worth? And so if you look at, and I'm overgeneralizing right now, but I'm basically want to buy high quality company and I want to buy it cheap. And you would ask me, what is quality? And I think quality is a term that's been thrown out around a lot, by investors.
Sure.
Warren Buffett probably provided the best definition. If the stock market was closed for 10 years, would you feel comfortable owning this company? And so interestingly, that when you look at a company and you ask yourself that question, suddenly a lot fewer companies kind of pass your quality test. And especially today, when the pace of change in technology has destroyed a lot of companies that used to be quality companies. But basically, for us, quality would mean a couple things. So, sustainable competitive advantage, which kind of answers the question number one, right? That's recurrence of revenue, a great balance sheet, and then the final element, which is as important to us, more important to us now than ever before, is management, and really kind of ask ourselves, how well management allocates capital and how well they run the business, which are two different questions, and two very different and very important questions. In fact, I would argue that when you analyze larger companies, you want to spend more time thinking about capital allocation. And when you look at the smaller companies, how well you shouldn't ignore capital allocation, but you find that management actually can add or destroy more value by the operational decisions they make.
Yeah, and I would agree with that. And I guess, do you guys concentrate, or are you more diversified? How many stocks do you guys typically own?
So we usually own about 20 to 30 stocks. So in the world of Manish Pabrai, we are very diversified. In the world of mutual funds, we are very focused.
Sure.
So it depends what your bogey is.
Yeah, and I think that's great. And you said you're looking to buy what you think are high quality companies that trading at cheap prices.
Yes.
What type of businesses do you typically look for? Are you sort of agnostic to the industries and sectors and everything in regards to that? You just go where value is, or how do you guys think about that?
So the answer to your question would be yes.
Nice.
Okay, no, but there are certain industries we usually avoid because they rarely have high quality companies. And I'll give you a few examples. Like for instance, companies that have a significant exposure to commodities. Usually those companies they don't have high returns on capital. They're usually very levered. So we usually have very little exposure to kind of commodity linked companies. Other than that, it's fair game for everything. So I'm happy to look at anything I can understand. So our portfolio historically, historically we owned very few kind of commodity linked cyclical companies. But other than that, I go over the values.
Sure. Yeah, and that's interesting. And I'm also kind of curious, I guess as a follow-up question from earlier when you were talking about investors should start to love to hold cash and I guess opportunistically hold cash. How much cash do you guys typically have maybe on average in your portfolios?
So this is more like so what we do here is a little bit different from other firms. We treat every account differently. So clients that came to us, let's say a year ago, 2 years ago, would own different stocks, or their portfolio would look different from the clients that started to us today. So clients that have been with us for a while, they may be 70, 80% invested. Clients that would come to us today would probably 30% invested. Because what happened was when we bought stocks, let's say a year ago, and they went up, at the time when we bought them, they had margin of safety. Now that margin of safety maybe not completely gone, but not enough for us to buy it for new account. So therefore, we're going to have a very large dispersion of how much cash we have based on the kind of basically on when we got the client.
Sure. Yeah. No. And I think that's very prudent. What has your experience been going from an analyst to actually managing the portfolio, and I guess thinking in terms of being a portfolio manager?
I think the most important experience was when I was an analyst. To me, first of all, I did not see stocks in the context of the portfolio. That's point number one. But point number two, and this is I did not link portfolios and clients. And let me explain what I mean. Because we run separate accounts. In other words, I got to meet or to talk to every single client of the firm. Now, when I make investment decisions, I actually am thinking about the doctor whose money I'm managing, who worked for 30, 40 years, and I manage 90% of his net worth. So therefore, every decision I make, there's a tremendous amount of responsibility, which when I was an analyst, I didn't recognize that it was there. Because to me, it was more about, how much is this company worth, how much marginal safety we have, etc. Now, as a portfolio manager and a CIO and CEO, there was a new level of responsibility that I did not know existed before I became a portfolio manager.
Sure. Yeah, and I could definitely relate to that. Yeah, that's definitely very interesting. So let's go back to 2006. And as I said, you were you were the pioneer in the blogosphere space, which I always joke about Geoff being that other guy as well. And before we went on, I guess when I was doing prepping for this, I actually went and on waybackmachine.com, and I was seeing when your first post was, and it looks like it was the end of 2006. So, I guess blogging about investing wasn't very popular back then. What prompted you to start a blog? And, Contrarian Edge obviously is very popular. And I guess, how has writing impacted you as an investor?
So, Andrew, I got to admit, I never considered myself a blogger. And let me tell you why. Because, I started writing, I think in 2004, 2005 for the street.com. And at the time, street.com was, when they hired me to start writing for them, they didn't pay me very much, and they overpaid me because I was horrible. But when I started writing for them, I realized how much I love writing. And over time, I never looked myself as a blogger. I always thought myself as kind of as a guy who writes articles. And in 2006, I think I started writing for Financial Times. And the Financial Times then put my articles behind firewall. And also at the same time, I was teaching investment class at CU Denver, and I wanted my students to read my articles. So I started to put my articles on a website, which I guess now it's called a blog. So that's how I guess I became a blogger. I never really considered myself a blogger because I was, for the most part, actually, over the last 15 years, I've written articles like Financial Times, Market Watch, Fortune. So I kind of, I don't know, I never thought of myself as a blogger, but I guess I am because I guess I have a website and I host it, so I'm a blogger, I guess. But most of my articles really, probably 80% of them were published somewhere else first, and then were republished on my site. And that's how I became a blogger. About process of writing, I find that that's probably the best thing that ever happened to me, like as an investor, because writing makes you think so much more and so much more focused about topics than anything else you can possibly do. And I write on a daily basis. I think I get up maybe 5:30 every day, something like this, and I write for about for a couple hours a day in the morning, and then I come to work and I don't write anymore, and then until the next morning. And I find that it's the only reason I can talk about complex topics today, some of the complex topics, because I've written about them in the past. And writing basically helps me to organize my thoughts and go much deeper than I would otherwise possibly could go into a topic. And also, it basically replaces meditation for me. Because for a couple hours a day, I I wake up in the morning, I put my headphones on, I put classical music, I listen to music, and I write. And I feel that this is, if I did not write, I would not have, my investing IQ would have been so much lower than it is today.
Yeah, I would agree with that. I mean, it's definitely just a way to tune out the world, and you're really, when you're writing for other people, I always say you're actually writing for yourself, right? And you're just sharing it with other people.
This is kind of interesting. So this may take us into a different rabbit hole. I just finished a 29-page article about Tesla and EV industry, and I basically, what caused me to write it, I bought Model 3, and I loved the car so much, I realized this is actually going to change the auto industry tremendously. But I really wanted to understand it better, so I wrote a 29-page article for myself, which is going to end up being published somewhere. And it's probably going to be maybe 8 articles, not one.
Yeah.
Okay, but I literally, when I was writing it, I didn't think about length. I didn't think about all the constraints that you have when you write. When you write for Financial Times, they tell you, your story has to be 800 to 850 words because you're constrained by space. Here I was, and I do this a lot more now. I basically write for myself, and then because I'm curious in this, and then it gets published. So I guess that's probably one of the biggest transitions that happened to me over time. I've been writing a lot more for myself, and now because most of my articles are published in online, I don't have to worry about space as much. And I also learned that even if I write a long article, most of the time it can be broken up into 2 or 3 articles. So I've done plenty of that actually too.
Yeah, that's fantastic, and I that's great to hear. I mean, we love writing, and my partner Geoff, when we've talked about certain things within our firm, and he spends 100% of his time on investing. He has always said, I just want to be able to do 2 things. I want to be able to have the option to write about whatever I want, whenever I want, and I want to be able to focus on investing. So obviously writing is very important to him too. I'm kind of curious, what's your 10,000 foot overview? I know you spent a lot, 29 pages on writing about Tesla, but what's your 10,000 foot overview on the company?
It's actually ended up being very different than it was like maybe a month ago. So I'm actually started to appreciate a lot more what they have accomplished. And I realized that there is a much, like maybe if you and I talked a month ago, I would have said that the probability of success is probably not very high. And now I would say it's much higher than I thought it would be. And the reason for that, because what I realized that when we look at the electric car and you look at the ICE, internal combustion engine car, they look very similar, right? I mean, they kind of, there may be different form factors, maybe different design, etc. But they look, a lot of times you can't tell the difference. If it's like you would drive on the road and you see Nissan and you don't know, like for instance, is that Nissan gas powered or it's a battery powered Nissan, right? But what you realize that yes, the outside looks different. I mean, the outside looks look very similar, but the insides are incredibly different, and the difference is so dramatic that it's not just like I'll give you an analogy. In 2004, we owned Nokia. Actually, no, Nokia in 2004, Nokia stock got pummeled because Motorola came out with flip phones and Nokia did not have flip phones. And so Motorola sales jumped and Nokia sales stagnated. So we bought a lot of Nokia stock, and it's 6 months later, Nokia came out with flip phones and the stock doubled. So we made a lot of money. In 2008, a year or two after, maybe 2 years after iPhone came out, Nokia stock got declined again, and because of iPhone. And I was very smart then. I thought, well, I've seen this movie before. they'll come up with a new phone and they'll be fine. Well, what I didn't realize at the time that where, flip phone and a clamshell phone, or whatever, the normal flip phone versus the whatever chocolate shaped phone, whatever chocolate bar shaped phone, they were in the same domain. It just it's basic transition from one kind of hardware factor to another. Transition from a dumb phone to smartphone was a fundamental shift in domains. In other words, you went really from a from a dumb phone to a computer that also happens to make phone calls. But actually making phone calls was not the most important feature of the computer. And Nokia has failed miserably at that transition. And the reason they have, because they failed at this transition because their skills, they had a very different skill set. To be good, to make good smartphones, knowing how to make hardware was not enough. You also had to write software. You have to also design new user interface. The skills that Nokia really did not have. In addition to that, and this is very important, when you shift from one domain to another, like from dumb phones to smartphones, your assets could very quickly become your liabilities. Because if you think about Nokia, at the time, it employed thousands and thousands of engineers, but those engineers did not have the skill set that was needed to create smartphones, because they needed to be, Nokia needed to employ a lot more software engineers and less engineers that focused on on plastics or whatever that, goes into dumb phones. So therefore, to make things more difficult, Nokia would have to lay off a lot of people, and it would have to bring new talent, and it would have to basically, to compete with somebody with Apple, they had to look. They basically need to re-engineer the firm kind of in mid-flight, which is very difficult to do. So if you apply this analogy to cars today, I would argue the transition from ICE cars to electric cars is of the same complexity of magnitude. So General Motors basically has to continue to make like ICE cars, but it also has to invest into electric cars, and that means it has to hire people who are not tainted by the knowledge they have from ICE cars world, right? Because if you think about it, the first car General Motors created was Volt, which was basically kind of a version of a gasoline car, where so the long story short, after I did all this research, I realized that today to me, it's not that I want to buy Tesla stock, but I started to appreciate that they actually have a very good chance of success if they can survive over the next year or two. Because this is the company losing a lot of money, and if you go into recession, they may have to issue a lot of and their stock price declines. They may have to issue shares, which would they lose shareholders. And I also appreciate that actually that the reason I actually was comfortable buying Model 3, because I realized it's very unlikely that Tesla will go bankrupt, because that was something I was worried about, because most likely somebody will buy them. So if the stock price declines and they have financial losses, they will be valuable. The equity will be valuable to somebody. If you are an equity investor today, you may still end up losing money. But as a car owner, I worry less about them going bankrupt now, because somebody will buy them and continue to service, to service the car. But also going through this, 29-page article, I realized that ICE makers, the traditional car makers to me are uninvestable today, because I am not sure which ones of them are going to be Nokias and Blackberries, and which ones of them are going to be kind of the Samsungs. So because if you look at what happened in 2008, so Nokia and BlackBerry basically became irrelevant, and for all you care, it's they might have as well gone bankrupt, right? Because the core businesses that made them a lot of money kind of disappeared. So they're making money now in doing something else. And companies like Samsung actually, that was also made a lot of smart, dumb phones, actually was able to survive and actually prosper, in the transition from dumb phones to smartphones. So when you look at car makers today, it's very difficult for me to say right now which ones of them are going to become Nokias and which one of them are going to become Samsungs. So therefore, to me, that sector became uninvestable.
Got it. Yeah, and it's been so fascinating watching from from the sidelines. It's not something that we would ever invest in or short or whatever, but just kind of sitting from the sidelines and watching all the action that's been happening in Tesla. It's been quite entertaining. I'm curious, what are your thoughts on Elon Musk?
I think it's a very complex thought. On one side, if you just look at what he has accomplished, you're at awe, right? Because just even beyond Tesla, just look at SpaceX and you say, oh my God, he's able to make rockets that are 10 times cheaper than NASA could, or the competitors, and also he can set a rocket to space and then land it on a barge that's the middle of the ocean, which is incredible. It's a incredible accomplishment.
Definitely, 100%.
And then if you look what he did at Tesla, and you start to appreciate what he did. It's not just what's important to understand. It's not that he just created another car company that runs on gasoline. He basically created a car that's where they designed a battery and that has this run a completely different technology which they had to create. In addition to that, they built out superchargers across not just the United States but Europe. In addition to that, they designed a computer that is basically is in charge of self-driving or for Model 3. And the processor, they created the processor that is as good or arguably better than NVIDIA, who knows? But it's as good as NVIDIA's processor. And in addition to that, they vertically integrated. If you think about automobile companies today, none of them are vertically integrated. In fact, they used to be vertically integrated, and then they basically kind of sold off the auto suppliers, and now they're basically in the business of assembling and marketing, kind of engineering, assembling, and marketing cars and wholesaling cars, basically. Where Tesla is completely vertically integrated. And by the way, in addition to that, he completely, when he created Tesla or Tesla the company and Tesla cars, he did it from a first principles perspective, where basically you have a blank piece of paper and you say, if you knew nothing about cars, how would you create an electric car today? And think about, aside from from the car, think about how they sell their cars, right? So, General Motors does not sell its own cars. It's basically, it's a wholesaler of cars to its franchisees, dealers. Tesla decided that they want to control the whole process. And so therefore they took Apple's model, where they basically have a store and they sell you the car, they service the car, and then at some point in time they're going to try to help you to upgrade to another Tesla. So if you look for what he has accomplished at Tesla, it's absolutely mind-boggling. But, and here's the but. The problem with Tesla is that's a company that's losing a lot of money. And for Tesla to succeed as a company, they can basically raise money two ways. They need to raise money. And they can only raise money two ways. They can issue equity or they can issue debt. They can issue limited amount of debt just because, again, this is a company that's losing money. So therefore, he has to rely on the kindness of equity markets. So to do this, Elon Musk always has to tell a story to keep the price high. And sometimes he tells stories that will, may happen just later than he originally expects them to happen. And sometimes he tells stories that are borderline lies. and it's very difficult to distinguish between them. I'll be very honest, because if you look at when he announced Model 3 in 2005, I forget but let's say by 2007 they were supposed to be producing the 500,000 cars or 1,000,000 cars. Well, I think they will be, we are in 2009, and in the fourth quarter of this year they'll be producing roughly 500,000 cars, at a run rate of 500,000 cars a year, which is, to be honest, it's still yes, it's 3 years late, but it's still incredible achievement. Because he's the largest, EV maker today in the world. At the same time, you start thinking about some of the promises he made, and maybe a lot of these promises will not come through. So there's two sides to Elon Musk, where he's kind of promoting he's telling you some stories that you don't know if he's intentionally lying or not. I really can't tell. Mm-hmm. And that's why he gets in trouble with some investors, because they look at him and they say, well, he's kind of like a charlatan a little bit.
Sure. Yeah.
So he's a very polarizing figure, I guess.
Oh yeah, for sure. And like I said, it's been definitely entertaining. I think 2018 and 2019 has been, especially with everything with Tesla, it's definitely been not boring. So that's great. So I want to, kind of start to wrap it up here. And one of my,
Mm-hmm.
I really enjoy this conversation. And your background is incredible, especially going from Russia and then coming to the United States, and then going from analyst to CIO to CEO, and it's definitely so inspiring to listen to that. One of my closing questions I always ask people when they come on the podcast is, if you had to give advice to somebody listening on how to get better, right? Not even just investing, but I guess continue to climb in life. What would you tell them?
You want to be deliberate. I'll give you this analogy. So I've been skiing for a long time. I live in Denver, so close to the mountains. And for a long time, I noticed that my skiing does not improve, because all I do, I get on the mountain, I go down the mountain. And then I started to ask myself, how can I get better? And I realized for me to get better, I had to take ski lessons. After I took ski lessons, I knew now I knew what's right, what's right thing to do, what's the wrong thing to do. But the second step was actually I started to deliberately practicing. So every time I would go down the mountain, I would start thinking about, my form. I would start working. On this run, I'm going to be focusing on turns. On this run, I'm going to be focusing on trying to create as little friction as possible. So this deliberate practice allowed me, became because deliberate practice has a feedback loop. So you're doing something and then you are start thinking about, am I doing it right? And you start self-correcting. And therefore, when I go down the mountain now, with every run I improve just a little bit. Just a little bit because of the feedback mechanism. So I think the same thing with investing, or anything in life, I guess. When I invest, I constantly think about our decision-making process, and I constantly ask myself, how can I improve our process? What tweaks can I make to it? And then we analyze our decisions, and so we try to be everything we do, we try to be thoughtful and deliberate about it. And therefore, I think that's the only way to get better.
Yeah, I would agree with that. The basic blocking and tackling, and staying persistent, and just working at it every day. I think that's really great. Well, Vitaliy, I want to thank you so much for coming on the podcast. This has definitely been one of our top shows for me, and it's been awesome getting a chance to talk to you. How can people reach out to you or get some more information on you if they want to learn about your firm or just learn more about you?
Okay, well, let me give you a few websites. So our corporate website is imausa.com. My blog, you can reach me, you can read my articles on contrarian edge, edge.com. And we have a podcast, which is really not a podcast, more like articles on tape, or audio articles. It's a investor.fm, or if you just go to the iTunes store, to your podcast app, look for the Intellectual Investor Podcast, and you just basically get to listen to my articles instead of straining your eyes. You can strain your ears, I guess, instead. So
that is great. I love that. Well, Vitaliy, I want to thank you so much for coming on the Focus Compounding Podcast, and I want to thank everybody for tuning in with us here today. Definitely check out his stuff. He's got a ton of information out there on the internet about his writings and everything related to investing. I have read Active Investing as well, so definitely check out those 2 books and check out the podcast as well if you want to listen to his stuff. I want to thank everybody so much for tuning in with me and Vitaliy here today. We will see you in the next podcast. Take care.
Hey, this is Geoff Gannon, and that was the Focus Compounding Podcast, the podcast where Andrew and I talk general investing concepts. To learn about specific stocks I like, go to focuscompoundinggazette.com. That's focuscompoundinggazette.com, and enter your email. Once you enter your email, you'll start getting 1 free 2,000-word stock write-up a week. Andrew and I also manage accounts for clients. To learn more about our managed accounts, email Andrew at info@focuscompounding.com or text or call Andrew at 469-207-5844. Thanks for listening.